Today we're going to be covering all things tax-free income in retirement, including the ins and outs of Roth IRAs. I'm Steele, financial advisor with Mainsail Financial Group, an RIA located just here in Bellevue, Washington. And I'm super excited today to be covering all aspects of Roth IRAs. Many of you may know that there are really generally three different ways that any investment can be taxed. And what we're going to focus on mostly today is the tax-free side of it, or many may be familiar with this concept of a Roth IRA, Roth 401k. A lot of our clients are asking questions about this as it stands, and many have questions about whether Roth conversions may be right for them. One of the biggest signs to consider a Roth conversion is if you find yourself in a position where all of your assets are in one of the three tax buckets. A lot of the folks that we meet with find themselves almost entirely in the pre-tax or the 401k bucket when it comes to retirement. And although that's great, you've received a lot of tax benefits looking backwards, the challenge is that what this creates is a scenario where in retirement, you're really stuck down one path. If you find yourself in these shoes, exploring Roth conversions certainly may allow for a bit more flexibility down the road. Another consideration when exploring Roth conversions is if you find yourself in a scenario where you're looking for tax diversification. You may remember earlier we covered the tax triangle, really highlighting the different ways that any investment account can be taxed. Well, just like you want to diversify your investments within your retirement, you may also want to diversify your tax liabilities. And that way, no matter what happens in the future, you can bob and weave and make the most of any tax landscape that comes down the road. If you expect taxes to go up, you obviously may want to explore some Roth conversions as well. What this creates is a scenario where you may pay slightly more taxes today in exchange for tax freedom down the road. So as you might imagine, if you do expect taxes to go up, having some money in Roth might be helpful to help reduce that future tax impact and therefore spread out some of that tax liability along the way. One of the bigger considerations to explore Roth conversions is if you find yourself in a scenario where your required minimum distributions or RMDs are more than you actually need in retirement. What happens here is I actually ran into a client just a few weeks ago who had been saving really diligently. They had worked really hard to build up their nest egg and found themselves in a scenario where they've got over $3 million in pre-tax retirement assets, which sounds great, but they're very frugal and they don't spend a whole lot. And what this means is that because the IRS has given such a large tax break for so many years, once you hit a certain age, the IRS is actually going to force your hand and require you to take distributions from these types of accounts. It may sound like a good problem to have, and I will share, it certainly is, but for this type of scenario, what's happening is this client is going to be forced to take out much more than they may need, and therefore be bumped up tax brackets and have to pay significantly more in taxes than they ever expected or did even during their working years. So if you find yourself in these shoes where your required distribution is actually more than you need in retirement, you certainly may want to start exploring Roth conversions as well. Roth conversions also help significantly just to provide more flexibility. The idea of having tax-free income in retirement can help you for the what-ifs in life. We can plan as best we can for the day-to-day expenses, but we never truly know what's on the horizon. So by having some money in Roth assets, it allows you to be able to adapt based on what comes up and make sure that you have some tax-free assets to pull from in case the unexpected does happen. The last consideration to explore Roth conversions is if you want to enhance the legacy that's left to family members or kids or loved ones. And what I mean by that is that any retirement account is allowed to have beneficiaries on them, which is great. Obviously, that allows you to pass assets to your kids or loved ones. However, depending on the actual structure of the account may dictate how that money is taxed, not just to yourself, but to your beneficiaries as well. So if you find yourself in a scenario where all of your money is in pre-tax assets, when that goes to your beneficiaries, they will also be taxed when they take that money out. However, the Roth would allow you to actually pass tax-free assets to your loved ones. Now, this may mean that they still have required distributions on those assets, but if they're tax-free versus taxable, can obviously create a lot of opportunity. And especially if you find yourself in a lower tax bracket today than your beneficiaries may be in the future, this is a great opportunity to explore Roth conversions and potentially pay a much lower tax bill now versus what your beneficiaries, loved ones, children may pay in the future. Many may also be wondering what pitfalls to avoid when you're exploring a Roth conversion. One of the biggest pitfalls to watch out for when exploring Roth conversions is the fact that these conversions are taxable. And so what that means is if you convert too much, you may find yourself jumping up tax brackets and paying significantly more tax than you had the prior year. That may still be well and good. It may still be the most strategic play to make. So you may want to consider how these Roth conversions may impact your total taxable income and how that affects your actual tax bracket at the end of the year. It's also really important to consider where the actual taxes will be paid from. When you do these Roth conversions, again, we are creating more income and therefore likely a higher tax bill. So the question is, where do those taxes come from? And generally there's two options to explore. One is that you can actually withhold the taxes when you do the conversion itself. So if you converted 100 grand, you could withhold 20%, let's say, and hopefully that nets out at the end of the year to be pretty close to even. The other option is that you can actually pay it from cash. So you can convert the full 100 grand, but not withhold any taxes. Now what that means is, of course, you are very likely to have a larger tax bill at the end of the year, or when you file in April, I should say. But either way, it actually allows for a bit more of a savings effect, because if you convert 100 grand behind a tax wall, in other words, you actually have to pay taxes when you do take that 100 grand out and convert it into something that no longer has any tax consequences, you've basically created an extra savings effect as well. So if you find yourself exploring Roth conversions, if you have the cash available to pay the tax, is the more ideal scenario to get the most bang for your buck and really enhance your retirement savings. It's also really important to be aware of what they call the 5-year rule when it comes to Roth contributions, but more importantly in this case, Roth conversions as well. And the reason I highlight this is because what this really dictates is how long you must wait until you can access any Roth monies. And the most important aspect from a Roth conversion perspective is that there is actually a new 5-year timeline on every Roth conversion you do. So let's say hypothetically you did a Roth conversion in calendar year 2024. What this would mean is that you actually have to wait until 2029 before you can fully access those dollars, fully tax-free and what they call qualified distributions. And let's say you did another Roth conversion in 2025. Now you have to wait until calendar year 2030 before you can actually access the funds related to the 2025 Roth conversion. So all the conversion monies from 2024 are now free, but again, each year that you convert, there is a new 5-year clock that starts in order to be eligible for fully qualified distributions on those assets. One of the most commonly missed pitfalls, but also one of the most important to be aware of, is what is called IRMA surcharges, and this relates to Medicare premiums. So what this suggests is if your income is too high, there is actually a premium surcharge on your Medicare premiums moving forward. And the reason this is so important as it relates to Roth conversions is because if you take pre-tax money and convert it to Roth IRAs or tax-free money, as you know very well at this point, all of that money is taxable in the year that you do it. So if you find yourself converting too much, you may actually find yourself in a position where your Medicare premiums increase. And there is in fact a 2-year look back on that as well. So it's not just about the current year, it's also important to be aware of how this affects years looking backwards. For 2024, these limits start at about $103,000 for individuals and about $206,000 for joint filers. So if you find yourself anywhere near those thresholds, you just want to be aware of them. It doesn't mean that Roth conversions don't make sense above those points, but you want to make sure that you're aware of them and understand the extra cost that you could be incurring on your Medicare premiums moving forward. I hope you found the information helpful today. We share a lot of information around tax planning and retirement planning strategies on our YouTube channel, so please do like and subscribe to the channel for more information. We are also going to include a link to a free copy of my book, Retire by Design, below. So if you are interested in more information on not just tax planning, but the rest of the retirement planning picture, please do follow that link to claim your free copy today.